In this lesson, we're going to pick up with where we left off in the last lesson. That was looking at intercorporate transactions. And more specifically, in this lesson, we're going to look at land sales and what happens when a parent sells land to a subsidiary or vice versa. So now we're in scenario E, which is a land sale transaction. Let's say that GCO, the subsidiary, buys land from PCO, the parent, for $75. The land cost parent corporation $45, resulting in a gain of $30. GCO holds the land for 2 years and then in year 3 sells it to an arm's length purchaser for $100. This is a downstream P to S transaction because the parent is the selling entity, which means that we don't need to worry about the non-controlling implications of any consolidation adjustments. In year 1, parent corporation would recognize a $30 gain on its non-consolidated financial statements from the sale of the land, yielding net income of $18 after tax. GCO, on the other hand, has recorded $75 in its capital assets on its books. As the land itself has yet to leave the bubble, for consolidation purposes, we need to eliminate the profit recognized by parent corporation and the associated bump up in the land value on GCO's books. The elimination entry unwinds the transaction between parent corporation and GCO as if it never happened. In other words, it's another funny money transaction along the lines of what we discussed previously with inventory. The taxes paid by parent corporation get set up as a deferred asset in the consolidated working papers, which will be realized with the gain upon the ultimate disposition of the land to a third party. What we are left with is land carried on the balance sheet at $45, its original cost to the consolidated entity. Year 2 comes along, and parent corporation and GCO's books will continue reflecting the sale as if it had happened legally in year 1. However, the consolidation entries posted in year 1 would need to be again posted in year 2's consolidated working papers as GCO continues to hold the land at the year-end reporting date. Notice how the land continues to be carried on a consolidated basis at its original $45 cost. In year 3, GCO sells the land to a third party and records a $25 gain on the transaction. With the criteria for revenue recognition now achieved, the consolidated entity will recognize the gain on the initial transaction between PCO and GCO at this time. The result is that the consolidated results now reflect the full gain of $55, or $33 on an after-tax basis, on the sale of the land between the consolidated entity and the third-party purchaser. Note how the tax deferral, too, has been reversed to align with the gain recognition. Scenario F is the same as Scenario E, only as an upstream transaction, that is, an S to P transaction, which means we need to factor in the non-controlling interest into our calculations. GCO sells the land in year 1 to PCO for $75, reporting a legal entity gain of $30. PCO holds the land for 2 years and sells it to a third party in year 3 for $100, reporting a legal entity gain of $25. At the end of year 1, PCO will have the land on its books for $75, which it paid to GCO to acquire it. GCO records a gain on the transaction on a non-consolidated basis of $30 and pays tax on this amount of $12. On a consolidated basis, however, the transaction gets nullified as the land has yet to actually leave the bubble. As a result, the gain gets reversed and the land carrying value reset to GCO's original cost of $45 in the consolidation working papers. The taxes paid by GCO get deferred in a deferred tax account as if the entity had prepaid taxes on the gain it has yet to recognize for accounting purposes. In year 2, parent corporation continues to hold the land, and the consolidation entries from year 1 will carry forward and be reposted again to the consolidation working papers in year 2 to continue reflecting the land value in GCO's books at the original $45 cost. In year 3, parent corporation sells the land for $100 to a third-party purchaser and records a gain of $25. We can now record the deferred profit and the deferred income taxes on the initial sale from GCO to PICO of $30 and $12 respectively. At the same time, the non-controlling interest is now allocated its portion of the gain earned by GCO of $4. Are you starting to get the hang of this yet? Let's look at the sale of depreciable assets in our next lesson. So until then, don't stop to get to the top. When you get to the top, don't stop.